Look, I'm going to say it. My Vanguard portfolio is misleading. But I actually don't think it's any different to your very own portfolios, if I'm honest. As part of my preparation for this month's Vanguard Portfolio update, I wanted to build a fleshed out picture of who you are. Well, at least a sculpted avatar of my average viewer. But using my own YouTube analytics, I know that you're very likely to be British, well, at least 85% of my audience is. You're also very likely to be male, like 96% of my audience, and that you're likely aged to your mid to late 30s, as 82% of my audience falls between the 25 to 54 bracket. But following a series of community polls I've run over the last week, and a big thank you to the over 1,100 people who took part, I now know that the average amount invested by you is about £450 per month, and you've been investing for coming up to about 3 years now, meaning that you likely started investing just either before or after the pandemic started. But I can actually go further, as I also ran a poll several months ago asking what percentage of your net income you're investing at the moment. Based on this, I believe the average salary of my viewers is about 10 to 15% above the normal average for your age, so around £33,000 to £38,000 mark. So well done you. Well, I have a theory that your portfolio is in bigger trouble than you might think. You probably feel a lot like I have recently.
Yeah, the markets are down a little bit, but it means I can get more for my money, so it's not too bad. And when I look at my portfolio, it's barely moved at all.
And all of that is very much true. Looking at a chart of my top line value of my portfolio, it's actually flatlined since November last year. Back around my birthday, I was about £72,500. And now we're at £75,000. So the market sold off by 7% since the start of the year, and I'm actually up £2,800. And I'd bet a good amount of money that your portfolio is likely the same. Your value of the shares that you hold has likely dipped over the last few months, but the value of your total portfolio has likely stayed the same, if not risen. And it's down to the simple fact that our monthly deposits make up such a large chunk of our overall portfolio still. Let me use an avatar of my average viewer, for example. They will have started investing around the start of 2020, and they probably started off investing £200 a month, but they've gradually increased up to around £450 right now. Based on this, let's say their average deposit over the last 2.5 years has been around £360. This means they'll roughly have a balance of £11,800 with a humble amount of profits of about £1,000 in total. But by the numbers, this means you're investing roughly 4% of your total portfolio value every month, meaning you're likely growing your portfolio by 50% in a single year just by depositing. It would actually take an almighty crash to your portfolio to show a visible decline. And I'm in a similar boat, as my current deposits equate to roughly 1.25% each time every month towards my portfolio value, meaning annually I'm contributing roughly 15% to my portfolio every year. So unless the stock market is going to be dropping by 15 to 20% at least in a year, my portfolio just isn't going to show it. Well, I'm highlighting this as I believe that we, and I include myself into this, are sleepwalking into underperformance. We all spend a lot of time speculating and discussing stock market performance, whether it's past, current or future. And we all know that this is something that is far out of our control, and it's a fool's game trying to predict what's coming next. Second to that, we know that the biggest factor which dictates our profits is the length of time we have been invested in the stock market. And by large part, this is out of our control as we can't create more time. So this brings us down to the only real metric we can really control when it comes to our investments, and that's how much we can invest. And this factor is under significant threat from two different angles. The first is the fact that investing is funded by disposable income. And I don't think I need to run a poll to show that investing comes after your rent, feeding your family, and maybe heating your house. It's very much a safety need rather than a physiological need, as represented by Maslow's hierarchy of needs. So, as the cost of living crisis continues to collapse around us, the first part of your spending, which comes under pressure, is how much you can invest every month. It means that every £10 we have to reduce in how much we can invest every month due to shrinking disposable income is another £120 less we're going to have in the future due to compounding. And a build-up of this reduction is going to create a large hole in your expected investment pot at the end of your investing journey. And the only way you'll be able to repair that hole outside of growing your income is simply investing for longer. But it's worth noting that you'll likely be in your early 60s in 25 years time, and by that point another year might be another year too long. But this is only half of the problem. Let's flip to the other side of the coin. By the very definition of inflation, it means your money has less purchasing power over time. It's hard to see the impact on the stock market right now, as valuations have naturally decreased due to the economic conditions and outlook. But theoretically, the same £450 you're investing each month should technically not go as far, as everything should be more expensive to purchase. So your £450 might start only buying 9 shares instead of 10. This reality isn't here yet, but it will be coming. As inflation washes through into the earnings of companies, it will only put upwards pressure on stock valuations. For this reason, it's why the stock market will never technically stop growing, as it's denominated in fiat currency, which is inflationary. So over time, as more money is printed and the money inflates in value, the stock market will grow, as the same stocks will have more money chasing after it. And this sort of valuation growth doesn't help us either. Yes, we'll all have a bigger number sat next to our Vanguard accounts, but that money will not go anywhere near as far as we think it should. You might hit the £1 million mark sooner, but only be extremely disappointed once you're confronted by the fact that £1 million won't buy you that much. So you can't control what the stock market does, and you can't realistically control how long you can invest for. So that only leaves you with one option if you want to stay on track with your investment goals. And this is to make sure that you're actively working on ensuring that your earnings are at least keeping up with inflation. Going back to my average viewer, if they want a salary of £35,000 last June, this means they need to be now on a salary of £37,500 just to keep up with inflation. And to top it all off, the Bank of England have actually confirmed that they're expecting double-digit inflation rates by autumn, meaning that £35,000 last June needs to be £38,500 by this autumn. But how you go about achieving this for yourself is completely up to you, and you might have more options to do this than you might think. The first is often overlooked, and it's cutting down on your lifestyle. Personally, I think this is the hardest mentally to do, but it's actually the easiest way when it comes to effort. A common practice in being frugal will be reviewing your expenditure and seeing where you can make easy savings. Common practices are changing providers when it comes to utilities like electricity and internet, while other methods will be looking at places where you shop, so maybe moving from your Waitrose to your Aldi, for example. All of these could easily save you a few £100s each month. All your other options are actually increasing your income, which falls into 2 buckets. The first bucket is getting paid more for what you do. You can go down the route of asking your current employer for more income. After all, if you don't ask, you don't get. Or if that's the route that you don't want to take or you don't want to ask, then your next option is to browse the job markets for another role which pays more. And now is quite possibly the best time to do this. Why? Well, for the first time in recorded history, there are now more job vacancies than there are unemployed people. So to get your head around that, for every unemployed person we have, if they all took a vacancy right now, there would still be jobs left over. And if you know anything about the basics of economics, you will know that when demand increases while supply stays constant, then prices go up, which in our case is salaries. So unless you've been in your job for less than 2 years, then I think you'd be mad not to either 1, ask for a larger salary, at least in line with inflation, so a minimum of 7% right now, or 2, move for another job with a minimum of expectation that you're going to be achieving at least 7% increase in your salary. The last bucket is a growing trend, and that is having additional income streams. It's only becoming more and more common to have a secondary source of income. Outside of my main job and of course YouTube, I actually do have other means of making income. I've actually done a video all about this topic, which I'll link at the end of this video. But overall, the message is the same. Your investments are under attack, even if your top line investment figures don't show it yet. If you don't take action very soon, then you'll start to get left behind by the economy, but I would love to know your thoughts. So, onto the Vanguard portfolio. If this is your first video, then it's a monthly series which I run where I talk about what's going on in the market, coupled with a review of how my Vanguard portfolio has performed over the last month. It goes without saying, but this is a live account. All the gains and losses are very much real. To bring you up to speed, this is all you need to know. The first is I only invest in the FTSE ALL-WORLD UCITS ETF, which goes by the ticker symbol VWRL. There are other great global ETFs from Vanguard, but I personally pick VWRL as it's well diversified in my eyes and it's really cheap. I started investing at the very start of 2018 with a bonus I've received from work, and then since then I've been depositing monthly into my account straight after I'm paid. I started out putting roughly £300 a month in, but then I've slowly increased that over the years to the extent where I'm now putting over £900 in every single month. And lastly, my investing style is lump sum investing. It's commonly confused with dollar cost averaging, as I tend to invest every single month. But I invest my disposable income as soon as I get it. A good visual indicator of this is the fact that I deposit bonuses in full straight into the stock market as soon as I get it, just like I did in March and April this year. So now you're all caught up, let's get into it. Last month, VWRL was starting to come off a bounce back that it had by trading down from £90 a share in early April down to £86.60 last month. During this month, it did trade down to as low as £82, but it has bounced back up to £85.50 over the remainder of the month. As you can see from my 1 year buy chart, I've been consistently purchasing throughout the year, and I've actually ended up buying another 11 shares for £82.57 on the 27th of May, which for note is actually the lowest price I've paid for VWRL since March last year, where I only paid £80.03. Regarding a value change to my portfolio, it barely looks like anything has changed. As I reported last month, I was on £75,446, and now this month I'm only £400 down at £75,043. You need to remember that I invested around roughly £940 this month. So if I didn't factor this in, I'd likely be down roughly £1,300 since last month. The best way to show you the true performance of this portfolio over time is manually exporting this data and inputting it into this hideous Excel graph. As you can see, in the early days, I was wiggling in and out of profit, but I did start to have a short run up in profits to around £3,000 at its peak before the pandemic hit. This £3,000 gain quickly turned into a £3,000 loss, but since then, my portfolio has gone from strength to strength, hitting a top of around £18,000 in profit, before the recent sell-off where it's actually traded down to roughly £14,000 worth in profits. But don't look at this graph thinking that I'm guaranteed to be always making a profit, as there is actual opportunity for me to be in a loss in the near future, as my current average buy price is £72.30, meaning if the market sold off between 16 to 17% more, then I would actually be in a loss. But even with the market volatility, all the data shows that the longer that I invest for, the more likely I will be in profit, which in fairness is currently what my data shows. So far, I've been rewarded for the hard work I've put in over the last few years, and right now I am working hard on my portfolio to be rewarded over the next 3 to 5 years. If you want to know more about how I make extra money to invest, then I highly recommend you check out this video just here, which are the best side hustles for people who are time poor. That's all for this video. See you in the next one.